The idea of capital stack is two things: the amount of debt or funding you're getting on each level, and also the risk on each of them. My purpose for this training is to ensure that we understand it. So while I was creating the slides, I decided to break the session into two. We will not be doing everything today. We'll be doing more of practical next week, because you understanding the theoretical parts might not just do you any good. It's important that you know how to apply it. So I'm going to do a case study next week and show you the implication of what each capital stack can do to you and all that. So the purpose is for us to understand it to the best of the way I can help you understand it. So today we'll be discussing capital stack and GP split. Some of us are not aware of how you can really structure a deal and make it pencil out. So there are ways you can structure a deal, and because of the capital stack, the deal will pencil out and give you good returns. So if you don't understand how to use it or when not to use it, because the excess of it is also a problem, you don't also want to do that. You need to understand it both ways so that you know when to apply it and when not to apply it. First of all, what is capital stack? Capital stack in multifamily real estate is acquiring a property with the necessary fundings. So if we understand that we're acquiring a property because of the necessary funding, it's important that we know how to arrange them. I'm going to show us a diagram of what I'm talking about, what a capital stack is. I'm using the pyramid to describe it because of what it means. For example, if we have a loan of $10 million, a purchase price of a property, let's say you want to buy a property in Texas and the property is worth $10 million, the bank normally gives the biggest chunk of the debt on it. But some people just do the bank and bring the down payment. There are other ways you can reduce the money you're bringing for down payment and ensuring that this deal is profitable to you. And we have the mezzanine and we have the preferred equity. Common equity is the one you bring down, or your GPs or your team members, your LPs. That is what is called the common equity. So I'm going to explain this further down the line. The idea of this capital stack is two things. It's showing you the amount of debt or funding you're getting on each level, and also the risk on each of them. So if you look at this arrow downwards, you see the lower the pyramid where the debt is, the lower the risk. And the higher it goes, the higher the risk. And I'm going to show you why that is shortly. Another thing I also want you to look at is the capital stack on the other side of what I'm sharing. The senior debt and the mezzanine debt is described as the debt aspect of the capital stack, whereas the preferred equity and common equity is the equity side of the stack. So these two are debts under the debt category, whereas these two are under equity category. So for example, you want to buy a property of $10 million and the lender is saying they want to give you $7 million, and now you're supposed to raise $3 million. You can decide that, okay, I don't have $3 million, I don't have investors that can give me $3 million. Okay, I'm going to structure it this way. $7 million will go to the lender. Lender is giving me $7 million, which is 70% LTV. So when you hear LTV, that's what they're talking about. So if the lender is going to give you that, you can say, okay, I still want to get a mezzanine debt. You can actually get that from a senior debt lender, or you can get it from another bank, someone else. But the senior lender must give their consent, must give you a go before this mezzanine debt must work. So I like to take the mezzanine debt with the senior lender if they are open to it. But if they are not, maybe we have a lot of equity on that property, we can bring in another lender to give us the mezzanine debt. So this is $7 million, $1 million debt. I can decide that, okay, I still cannot raise $2 million. I can only raise $1 million. I can bring in a perf equity person to give me $1 million and I'll raise the remaining $1 million. Maybe myself, my GP members, and some LP limited partners will come up with this remainder of $1 million. You can decide to do that. On this deal of $10 million, you only raised $1 million, and that is fantastic. So by the end, I'm going to give you the pros and cons and why you might need to consider not doing this a lot. So let me share my screen again. The capital stack overview, like what I've explained, we have the senior debt, we have the mezzanine, and we have the equity portion, which is the preferred equity and the common equity. For the senior part of it, the repayment is the priority. So when you take the first debt from a bank or from a lender, maybe Fannie Mae or Freddie, because those are the people that normally will give you the first debt. Federal government can give you that through Fannie or Freddie. You can also get it from bank, you can get it from a community bank, you can get it from CMBS bank as well. So there are different ways for you to get a senior debt. But when you get it, typically it's between 65 to 80% of the purchase price and is the highest priority. And they have, in terms of risk, their risk is very low because if anything happens, your property becomes the collateral for them. So let's say you're not able to pay them, they take it as the collateral for what you owe them. So that is why it is regarded as a low risk kind of capital stock. The next is the mezzanine. It's the secondary after the senior debt, and that one has a slightly higher interest rate than the senior rate. So if the senior rate is, let's say, 5.5%, a mezzanine debt might be 7.5 or 8%. It can even be up to 9%. It just depends on who you're getting it from. Some people might give it between 8 to 12%. So that's the kind of the disadvantage about a mezzanine debt. But the thing about it is that it's usually a small portion of a debt. So if you're looking at the interest rate, it might not really be that much in terms of payment. The risk involved in it is typically higher than the senior debt. After the senior debt is paid, they are the next in terms of priority. So I'm going to shift gear to the equity part of it. This is preferred equity. So many of us have been hearing about preferred equity. How does it work? We have preferred equity partners that can give you such money. We have family office. We have big corporations that can cut out big checks and give to you. Even third-party lenders can also do that. There are many out there, so you can actually look for them. The risk about this is that if anything happens, if your property gets foreclosed or maybe you're not able to pay them, they can take ownership of the operations of the property. So they put a lien actually on the ownership of the property. So if you say you're not paying them, they can decide to not take ownership. They now become the operator. They now become the owners in terms of the operators, and they displace you. So preferred equity kind of have power to do that because there's a lien that they put on your ownership for the property, and you do that through a legal document that they present to you to sign. So it's important that you check the legal documents before you go ahead and sign. So one good thing about preferred equity is that they're entitled to a fixed return, regardless whether you make profit or not during your cash flow period. Maybe during your whole time, you will need to pay them. It can also be deferred. So probably during your first year or your second year of operation, you found out that you didn't make profits and you don't have any cash flow to pay them, you can choose to defer this down the line. But the idea about it is that before any form of payment, after you've paid your senior debt and mezzanine debt is made, they come first. So after those two, they are priority. And the third one is the common equity. This common equity are people like us, the GP and all that. So if there's no profit, maybe there was no cash flow, maybe you've paid out all your cash flow to your senior, your mezzanine, and your equity. If there is nothing, you go home, there is nothing. You don't have any money. So that is the disadvantage of the common equity. But the good thing about the common equity is that they kind of receive a very good return in the sense that they receive cash flow if there is. They receive the tax benefits. If you're doing tax depreciation and bonus depreciation, they're the ones that take advantage of it. These other levels of the capital stack, they don't take advantage of those things and all that. If you sell, you also have the ability to get profits as well. So the common equity is actually divided into the limited and the GP. So under the common equity, that's where you find the general partners and you also find the limited partners. Is there a case whereby the limited partners can also be entitled to preferred returns? That is, to make their returns guaranteed after other debts have been made? Yes. There's a way that you can structure it that protects your limited partners, and I'm going to discuss that shortly. So in summary, this is what I'm talking about. I have a property, the purchase price is 14 million. I can finance this property this way. Let's say the senior debt lender decided to give me 65%, the mezzanine 10%, the preferred equity partner 10%, the common equity I was able to raise for my GP and my LP 2.1 million. You can arrange your capital stock. In quotes, this is exactly what I'm talking about. But there are more complex capital stock. I'm going to dive into the complex one next week, not this week. But for this week, now I'm going to talk about how can a limited partner be offered a preferred equity and at how much. I've seen limited partners being offered between 6 to 18% in recent time. I've seen that happen. That is, the GP partner, in order to attract more limited partner, can decide to give the limited partner preferred equity. And what is it trying to achieve, or what is the general partner trying to achieve? They're trying to attract the limited partner, number one, and number two, for the limited partner is a guaranteed amount that they will get, regardless of if there was cash flow or not. It can be deferred. That is the thing. So if you did not make money, you can defer it to when you are exiting and pay them off. The bottom line is, after the senior and the mezzanine have been paid, they come first and all that. So that is one thing limited partners would like to see, that, okay, I did not make cash flow. Yes, you did not make cash flow, because if I did not make cash flow, it's not guaranteed. And that's what you guys should know. The 70-30 split is not a guaranteed amount. It's as a result of how profitable a property is. So if a property is not profitable, I didn't make money in my 1 year. Let's say I structured a deal and I didn't put preferred returns for my limited partners. Assuming I did not make money, I can decide that, guys, I didn't make money, there's no profit to share. But in the case whereby I promised or gave them my word, 7%, you will get it. Whenever it is that I have that money, either during the whole period, because it's paid annually, I can decide to structure it on a quarterly basis. Instead of giving them a chunk amount of money annually, I can decide to give them quarterly to cover up for 1 year. But if I say that I don't have it because I didn't make so much, I can defer it to maybe year 2 or year 3, or when I'm exiting. And that's where we talk about waterfall. I'll explain that also next week, what waterfall is, how you can spill it over, but does not take you away from your responsibility. So preferred returns is a guaranteed way of securing your limited partner's money. In my deals, I try to structure it without it, and sometimes with it. It just depends on my deal. So, for example, if my deal is so profitable in terms of cash flow, that means regardless if I do the barest minimum on the property, I'll still make good cash flow. I don't get to put perfect equity, because preferred equity for the GP is a negative. And let me explain why. Because our source of returns, or what makes us happy, is from 3 basic things. From the acquisition fee. When we buy the property, acquisition fee is shared to the GP. So that's one way a GP gets money. The second way a GP gets money is through the cash flow. That means the 70-30% split. So if I don't make profit on that property, that means I don't get to get my 30%. So it's not really a motivation for a GP partner. For me personally, on my deals, this is how I've structured it, so that the GP partners will not be disgruntled or will not feel that this deal is not making money and it's only the limited partners that are profiting from it. This is what we do. I encourage the GP partners to put in their money, invest it as a limited partner, so that when a limited partner is getting returns as a pref returns, you also are benefiting from it. In that way, you're not feeling the crunch of LP-GP split of 70-30. If that comes, because there's so many factors that determines how profitable a property is. You might be operating it well, but things like maybe insurance might come up. They might increase the insurance, they might increase the taxes. Things might go off that you did not envisage for. That is actually beyond your control. Or maybe you have a floating rate and your interest rates climb from 3% to 9%. Obviously, that will eat up your entire cash flow. So you might not have any cash flow to distribute to yourself or to your limited partner. So to make everybody happy, I always encourage GP members. Yes, we're told that you can actually invest no money in multifamily real estate. I try to encourage people, if you're a GP partner and you're doing a perfect equity deal, try as much as possible to put in something, so that when your limited partners are having money, you also benefit from that. And when you now make profit, you also make money as a GP member. So in both ways, you're making money. That is what I've been doing since I started. So all our deals, we actually invest our money. Most times we even invest more than, we're the highest first investor in the deal because we know the deal, we understand the deal, and we want to take advantage of the opportunity that the deal brings to us. Please, this is a way you can mitigate the risk of just having perfect equity. If you're a GP, this is important because we're told that don't structure a deal with preferred returns. Well, me, I'm telling you, you can structure a deal with preferred returns, but put at the back of your mind that you should invest in that deal as a limited partner so that you have a guaranteed returns as well as a limited partner. Looking at this example, if I raise 3 million for my LPs and I promise them a 7% preferred returns for 2 years, the 7% is 7% of the 3 million, and that is about 210,000 monthly. So for the 2 years old, assuming I'm holding this property for 2 years, if I'm holding it for 2 years, this is just the returns during the whole period. This has nothing to do with the sales. If I'm selling as well, I'm still going to give them their principal at that time as well. So for the period I'm holding it, I owe them 7% each year. So over the 2 years, I'm giving them 420,000 as their preferred.